Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Welcome to the 3 in 10 podcast for Friday, July 24th, 2026. We're recording at 1 p.m. Eastern Daylight Time, and this is episode number 64. I am your host, Scott T. Slayton, Chief Market Strategist at Capital Creek Partners, a multifamily office based in Austin, Texas. Here's the starting lineup. Number 1, rising real interest rates. Why is this happening and what are the implications? Number 2, the Fed rate decision coming next week on the 29th. Will they tighten? And number 3, what banks and credit card companies tell us about the U.S. consumer. Now back to real interest rates. Why is this going on? We pondered it and have come up with several reasons. Persistency in inflation. Number 2, fiscal profligacy, leading to massive supply on the Treasury market. Number 3, a strong economy. There's just demand for capital, and nowhere reflects that better than AI-capex, where there's tremendous demand for capital, even borrowed capital at this point from hyperscalers. There's demand for capital economy-wide, and that is increasing. And monetary policy rates, in our opinion, are simply too low. They're not high enough to return the inflation rate to the 2% target. And inflation has become embedded especially in the services side of the U.S. economy. There's uncertainty on trade. We've got 2 major wars going on. We've got uncertainty with the administration's policies. And all of these things are adding up together to lead to higher real interest rates and nominal interest rates for that matter. What are the implications of this? Well, the greatest implication, in my opinion, is the greater cost of capital economy-wide. Governments, corporates, and consumers are all going to have to pay a higher cost of capital. What does that lead to? Well, that leads to a higher discount rate, and that puts pressure on equity valuations. And we've seen this basically all year long. We've had incredible earnings growth, and the stock market's up 7%. So clearly, we have had some degradation in multiples. Now, another possible implication is dollar strength. It's not something we've signed on to, but if real interest rates keep going higher relative to other countries, then the dollar could be stronger. What we noticed this week is this is a global phenomenon. Interest rates are going higher, nominal and real, across the world. And I think that's a very important distinction, and why we're not panicking on the dollar being strong. In fact, it's not really up that much this week, given how much rates are up. Housing, a very important sector of the U.S. economy. It remains moribund, and it's probably likely to stay that way with rising rates. Private equity and venture capital face headwinds from higher discount rates. They need to earn higher returns, given a greater cost of capital. Gold becomes less attractive. Gold produces no income. Now, you can buy a 2-year note for $4.35, and that's a lot of competition for gold. And tips become more attractive. A 10-year tip now yields 2.5%, and then you get to add that CPI inflation rate to the face value of your bond and compound that at 2.5% for years. 30-year tips yields are now 3%. It looks to me like the highest going back to 2007. So these are becoming some very attractive tip yields. Now, a long-term positive, but a real positive here is that the overall capital allocation should improve. When money is free, like it was during COVID, a lot of malinvestment happens. A lot of projects that should never have been done were done, and zombie companies get kept alive. But when real rates increase, everybody has to sharpen their pencils. because not every project makes sense anymore. This is a longer-term positive and probably leads to higher productivity, which is another long-term positive. So not all of this is bad. In terms of our strategic asset allocation, we are going to reiterate our underweight on Treasury bonds, not because they're going to turn into certificates of confiscation like they were in the 1970s with runaway inflation. We just think they're better investments to be made, and that you're probably just going to be clipping coupons for the foreseeable future in Treasury bonds, especially longer dated maturities where you could actually lose money on the bond itself. We don't find them that attractive. They are getting more attractive as yields go higher, but we're not enticed to jump in yet. Now the Fed, next week on the 29th. Kevin Warsh has already succeeded in making the market work to figure out what he's going to do. And we have taken a look at the voters on the Fed, and we've counted the votes, and we think he does have the votes to tighten if he chooses. And he may go ahead and do that. But our analysis tells us that while it's a very close call next week, we think they will likely wait until September to hike. Why would they wait? Well, we have 5 reasons why we think that they will ultimately wait and punt until September. Number 1 is the committees that Warsh has formed are still working. They have not reported back. They will not report back till the end of the summer or early fall, and he may want to see what they come up with before beginning the rate hiking cycle. Number 2, the doves are going to be begging to see 1 or 2 more inflation prints because they got a very good inflation print in June. Number 3, we count at least 3, maybe 4 or more voters who would dissent. We think Williams would dissent, Barr would dissent, at least in principle. Daley and Jefferson will dissent. And we're not sure that the new chairman is going to want to have all this opposition so early in his tenure. But we don't know. Warsh has come on pretty strongly, and we believe him that he wants to return this inflation rate to 2%. Now, what do Bessent and Trump think? I don't think we can be really sure. I think they've given him carte blanche to do what he thinks he needs to do because they are beginning to understand that inflation is the problem and not growth. But number 5, I think this is the most compelling reason that they may not tighten, is that the markets are already tightening for them. When you look at the spread between the U.S. 2-year note and the Fed funds rate, it's out beyond 70 basis points now. That's a big spread. And that is the 2-year note screaming to the Fed they need to tighten. But it doesn't necessarily mean they need to tighten next week. So the markets are doing the Fed's work for them, and they know that. They know that the 2-year yield leads their policy. It's not the other way around. The Fed does not lead the market leads the Fed. And I'm personally looking forward to these July Fed minutes because I think they should be very fun to read. It should be a rowdy meeting, a close meeting, maybe a toss-up meeting. And Warsh has said that he wants a family fight, so he'll probably get one next week. The trader in me thinks that bonds and stocks could actually rally if they hike. And you say, why would that be the case? I think it's the case because it would really underscore and help rebuild Fed credibility, and it would underscore Kevin Warsh as an inflation fighter, as a hard money inflation fighter. And I think that's what the markets want. I think it's what the administration needs. It's what the country needs. And I think markets would rally on that. And number 3 here, what banks and credit card companies are telling us about the U.S. consumer? Well, the second quarter earnings, anyway, reveal a consumer that continues to spend and pay its bills. This week, we dug into Capital One, Synchrony, and American Express. And these credit card companies are experiencing falling delinquencies. They're releasing reserves. And all 3 major credit card companies are expecting lower losses ahead. Otherwise, they wouldn't be releasing reserves. And the major banks told us the same thing last week. So consumer spending remains strong. And why? Because people have jobs. When you have an unemployment rate this low, the people that want jobs have them. And that leads to stronger consumer spending in the United States, where the consumer will spend up to the limits of their income and more, and they will continue to spend unless they lose their jobs. American Express said their card spending was up 11% year over year, the strongest since 2018. The affluent are crushing it. We know that. We know their customer base skews that way, and they're doing really well. Synchrony and Capital One mentioned that gasoline prices are a drag on the low end. We know that, but sadly, the low end just doesn't make up that much of the spending anymore. And when I look at these three stocks, this is a group of attractively priced stocks, at least on an earnings basis, a forward earnings basis. And if the consumer continues to thrive, as we think it probably will, these could catch up. Other financials of all kinds have done great, except for these, and these could catch up. So do the work, endure the fog of Warsh, and have investment prudence.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.